Hi, this is Neil, and I'm partnering with the great HPC Today to bring you the Surfactant Insights Podcast. M&A, mergers and acquisitions. It's quite exciting, isn't it? Conjures up visions of the novel Bonfire of the Vanities or movies like Wall Street, cigars, private jets, champagne, loads and loads of money. The reality, of course, can be a little different. Late nights, stale pizza, broken deals, loads and loads of spreadsheets. Nonetheless, M&A has shaped the surfactant value chain from beginning to end. From those early days of the acquisitions of Mironol or Carson Chemical, through to the spin-off of Cognis from Henkel and its subsequent pickup by the big battleship BASF. All those many deals also in the distributor space. It's a fertile ground for investment banks and various other advisors and, of course, private equity and the so-called strategic acquirers. Here's just a selection of deals that have been announced or done in the past year and some situations that are still developing, as it were. All the information I'm about to share with you right now is in the public domain, and so you'll get no hot stock tips here. First up, the big deal of the year in consumer products has been that Kimberly-Clark agreed to acquire Kenvue, the makers of Neutrogena, Aveeno, and J&J products. The deal was valued at a little under $49 billion. Kenvue, of course, is a significant user and developer of surfactants. In June of this year, Unilever acquired the US-based natural personal care brand Dr. Squatch. And in April, Unilever acquired the UK-based refillable body care brand Wild. So let's see if they can grow these brands globally. Stepan has done and looks set to continue to do some portfolio pruning. In May of this year, Stepan sold their specialty ester surfactant product line, produced at Maywood, New Jersey, to the Hallstar Company, and they got an agricultural product heading in the other direction as part of the deal. And in just the last couple of months, Stepan completed the sale of its manufacturing plant in the Philippines to ICOF and announced the sale of its fermentation assets in Lake Providence, Louisiana. Now, those fermentation assets were intended to be part of a manufacturing strategy for a rhamnolipids product line that Stepan bought from Logos Technologies. I'm not sure right now what the plan is for rhamnolipids at Stepan. Now, some big M&A situations that are still on the table, as it were, include the following. Shell has initiated a strategic review to divest major chemical assets in the US and Europe, including the important Neodol detergent range alcohols and ethoxylates business. No word yet on what is going to happen and who any potential buyers might be. Sasol has said in the press that their international chemicals business could be for sale as soon as 2028. This division is the home of the company's sizable surfactants and intermediates business, including LAB, LAS, detergent range alcohols of both oleo and petro provenance, and many other products. And of course, there's Indorama Ventures' ongoing plan to IPO Indovinya, a standalone integrated EO and derivatives business, comprising of assets formerly belonging to Oxiteno, Huntsman, Old World, and others. The IPO is apparently targeted for late this year or early 2026. So, other than the excitement, why do companies do it? The reasons for M&A include achievement of economies of scale, getting rid of non-core businesses, accessing complementary technologies or markets, tightening up the portfolio and increasing focus, or diversification. These things do tend to go in cycles. So what do we see going forward? And again, these are not hot tips, but speculative opinions. I do see increasing interest in North America as a manufacturing base for surfactants. And this will naturally pull in investors and acquirers from around the world. In the US, but not so much in Europe, I see continued consolidation, with the bigger companies continuing to look for add-ons. I also see some opportunities for portfolio cleanup at the big companies, and a role in that for the larger private equity funds. In summary, I see plenty, if not to keep the cigars lit, the private jets flying, and the champagne flowing, at least to support loads and loads of spreadsheets. I hope you've found this interesting, and as always, thanks again for listening.